Welcome to This Explainer. Okay, let's just dive right in, because today we're unpacking something that affects literally millions of us, but honestly, almost nobody fully gets it. We're going to look really closely at the hidden and surprisingly expensive reality of credit card debt right here in India. You know, for so many of us, it's incredibly easy to just swipe that little piece of plastic. We do it for the convenience, we do it for the reward points, the airport lounge access, the cashback offers, and it feels great in the moment. But if you ever carry a balance past the due date, or even if you just use one all the time and accidentally miss a full payment, the numbers we're about to explore are absolutely essential to your financial health. We're talking about the hidden trap of the plastic in your pocket.
So I want to start by asking you a very direct question, and I want you to really think about it for a second. What does your credit card actually cost you? Do you really know? We all see those bolded numbers on our monthly statements, right? The minimum payment due. And we might even vaguely remember the interest rate the bank rep quoted us when we signed up. But do you truly understand the mathematical machinery operating behind the scenes of that bill? Most people think they have a pretty good handle on their borrowing costs. They assume it's just a straightforward flat fee for borrowing money. But as we're about to see, the true cost is actually an evolving mathematical trick, buried under thick layers of financial jargon and invisible taxes that are specifically designed to catch you off guard.
Section 1. The credit card illusion. What you think you're paying.
When you look at credit card marketing materials, or you squint and read through the fine print of your terms and conditions, you'll usually see this one number heavily advertised. It generally looks a lot like 3.5% monthly interest. Now, on the surface, to the average person, 3.5% doesn't sound terrifying at all, right? It's a small, single-digit number. It feels totally manageable. And that right there is exactly where the illusion begins. This 3.5% looks like a tiny, harmless piece of cheese in a mousetrap. It acts as this psychological anchor designed to make carrying a balance look easy. Human brains, we tend to think linearly. You look at that single digit and you go, hey, it's just a few percent. I'll pay it off over the next couple of months. No big deal. But that 3.5% is absolutely not the whole story. In fact, it is literally just the starting line for a much larger compounding cascade of costs.
Which brings us to Section 2, the hidden 18% tax, the invisible cost of borrowing.
Okay, here is the piece of information every single Indian credit card holder needs to know, memorize, and just keep in the back of their mind every time they swipe. 18%. Every Indian credit card holder is subjected to an 18% goods and services tax, GST, specifically on their credit card interest. Just think about that for a second. We're super used to paying GST on goods, like buying a new TV, or services, like grabbing a meal at a restaurant. But here, you are paying a hefty tax on the actual cost of your debt. That means your true cost of borrowing isn't just the 3.5% per month the bank cheerfully advertised to you. It's that baseline 3.5% per month plus an additional, heavy 18% tax slapped right on top of that interest charge by the government. Let's actually break this down with a real-world, everyday example, because seeing the actual math brilliantly illustrates exactly how this silently drains your wallet. So let's say you had a large emergency or you made a big purchase, and you're carrying a revolving balance of 1 lakh rupees, 100,000 rupees, for just a single month. According to your advertised rate, your base interest charge is 3,500 rupees. Not too crazy, right? But then the tax rules step in. You owe an 18% GST specifically on that 3,500 rupees interest charge. That comes out to exactly 630 rupees. So suddenly, your total monthly interest charge isn't 3,500 rupees anymore. It instantly jumps up to 4,130 rupees. That extra 630 rupees is the price of a couple of coffees, or maybe a premium streaming subscription, and it is simply vanishing into a tax penalty every single month, offering you absolutely zero value in return.
Now, you might be wondering, why have I never noticed this steep penalty before? If it's draining my account, shouldn't it be obvious? Well, as the source material points out, banks often bundle it into finance charges. This tax is frequently entirely invisible on your standard monthly bill. I mean, bank statements are designed for quick reading of what you owe, not for a deep financial analysis. The GST doesn't typically appear as this neat, bolded, separate tax line item screaming, hey, look at this extra penalty money you're paying. Instead, it just gets lumped into a generic, incredibly boring-sounding category called finance charges. And because it just sounds like standard banking jargon, our eyes just glaze right over it. Unless you're reading your statement with incredible care, literally pulling out a calculator and running the math yourself, this extra 18% penalty slips right under your radar month after month.
Section 3. The true annual cost and the compounding damage.
So if we look at what this hidden tax actually means on a month-to-month basis, we can compare the advertised rate, that psychological anchor of 3.5% we talked about, to the actual mathematical reality. And the reality is an effective monthly rate of 4.13%. That is what actually leaves your bank account when you factor in the GST. You've instantly crossed the 4% barrier. Every single month you choose to carry a balance, you are paying well over 4% in interest and taxes alone. And look, that's a heavy burden for just a single month. But the real danger of credit card debt isn't just 1 month. What happens when we zoom out and look at how this math behaves over the course of a full 12-month year?
Brace yourselves, because here is the ultimate punchline of this explainer: 51.6%. Yeah, when you take that effective tax-inflated monthly rate of 4.13% and you compound it over a full year, your effective annual interest rate rockets to a staggering 51.6%. More than half the value of your initial debt is being charged back to you in interest and taxes over a 12-month period. At 51.6%, you are no longer in standard, respectable banking territory. You are seriously bordering on loan shark rates. If you carry a revolving balance on your credit card for a year, you are paying an unbelievably steep, wealth-destroying premium for that privilege. And honestly, this is exactly how small balances silently snowball into unmanageable financial crises.
Which leads us to Section 4, Better Borrowing Alternatives, Escaping the Trap.
The absolute crucial difference in how we should approach borrowing lies right in the tax code itself. Under Indian tax rules, standard mainstream loans, like personal loans or home loans, they are entirely GST exempt. That means there's absolutely no 18% GST applied to the interest you pay on those standard loans. The interest rate you see on a home loan is generally exactly what you pay. This massive invisible tax penalty we've been discussing, it's uniquely hunting credit card users. It's an isolated trap designed specifically for revolving unsecured credit card debt, which makes it a completely different beast compared to standard borrowing.
When you lay the numbers out side by side, the disparity is just enormous. And frankly, a little shocking. You have your typical home loans sitting comfortably down between 8.5% and 11% per annum. Then you've got personal loans, which typically range from 12 to 18% per annum, depending on your credit score, of course. And then towering above them all, like a financial tornado, you have credit cards sitting at a massive 51.6% per annum. The gap between credit card interest and literally any other mainstream borrowing instrument in India isn't just large, it's exponential. Looking at these stark realities, it becomes incredibly clear that there is simply no scenario in the world where using a credit card as a long-term borrowing tool makes any financial sense whatsoever.
So, if you ever actually need to borrow money for an emergency, or if you're currently stuck kind of treading water in credit card debt right now, you have far, far superior alternatives that completely bypass that 51.6% trap. You could take out a standard personal loan at a mere fraction of the cost, usually around 12 to 15%. You could take a loan against a fixed deposit, or even a loan against a life insurance policy, which are incredibly cheap ways to borrow against your own assets. Hey, borrowing from family might cost you a little bit of your pride, but mathematically speaking, even that is a brilliant financial move compared to eating a 51.6% annual hit. Literally any of these options will stop the bleeding and help you keep your hard-earned money.
So I want to leave you with a final thought and a direct challenge for today. Have you checked your recent statement's finance charges? After watching this explainer, I highly encourage you to pull up your banking app or just open your latest PDF statement. And don't just look at the minimum payment due. Look closely, read the fine print, and hunt for that intentionally boring phrase, finance charges. Run the math for yourself. Calculate exactly what percentage of your balance is truly vanishing into thin air every 30 days. Because once you see that hidden 51.6% annual cost operating in your own accounts with your own eyes, you really have to ask yourself, are those credit card reward points actually worth paying a 50% premium? Thanks so much for joining me on this explainer, and hey, stay financially sharp out there.